Hello, and welcome to Lecture 6 in our series on Introduction to Financial Accounting, brought to you by BNO Chartered Accountants. This session will focus on liabilities and equities under the International Financial Reporting Standards Framework. We'll explore key definitions, classifications, and examples while referencing relevant IFRS standards. By the end of this session, you should have a solid understanding of how liabilities and equities are defined, categorized, and reported in financial statements. Let's start with liabilities. According to the IFRS conceptual framework, a liability is defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefits. This means that liabilities represent amounts the entity owes to external parties due to past transactions or events. Settling these obligations typically involves transferring resources like cash, goods, or services. To summarize, liabilities have three main characteristics. Present obligation. There is a duty or responsibility to act. Past events. The obligation arises from past transactions or events. Outflow of resources expected. Settlement requires giving up resources that provide economic benefits. Liabilities are classified into two main categories under IAS 1, Presentation of Financial Statements. Current liabilities. These are obligations expected to be settled within 12 months or within the entity's operating cycle, whichever is longer. Examples include accounts payable, amounts owed to suppliers for goods or services, short-term loans, borrowings due within 1 year, accrued expenses, costs incurred but not yet paid, such as salaries. Non-current liabilities. These are obligations not due within the next 12 months. Examples include bonds payable, long-term borrowings through bond issuance, long-term loans, bank loans with repayment terms exceeding 1 year. Lease obligations. Recognized under IFRS 16, leases. When recording liabilities, IFRS 9, Financial Instruments, provides guidance on recognition, measurement, and classification. Moving on to equity, the IFRS conceptual framework defines equity as the residual interest in the assets of the entity after deducting all its liabilities. In simple terms, equity represents the owner's claim on the company's net assets after settling all obligations. It is essentially what remains for shareholders if all assets are liquidated and liabilities are paid. Equity is composed of several key components. Share capital. This refers to the funds invested by shareholders. IAS 32, Financial Instruments Presentation, provides guidance on the classification of shares. Examples include ordinary shares, common stock. Preference shares, shares with preferential rights. Retained earnings. These are accumulated profits that are not distributed as dividends, but retained for reinvestment. Reserves. These are specific allocations of retained earnings or other equity adjustments. For instance, revaluation reserve is created under IAS 16, property, plant, and equipment, when assets are revalued to fair value. The table below summarizes the main differences between liabilities and equities in terms of two characteristics, ownership and settlement. In essence, liabilities represent what the entity owes, while equity represents what the entity owns after meeting its obligations. In today's session, we explored liabilities, their definition, classification, and examples, with references to IAS 1 and IFRS 9. Equity, its definition, components, and examples, with references to IAS 32 and IAS 16. The key differences between liabilities and equity. Understanding these concepts is fundamental to preparing and analyzing financial statements. Thank you for enjoying our session today. Please like and subscribe for future similar content.